Hi, everybody. Scott Riley, the Market Update Desk, NMLS number 157524. We started a new month. It is April 1st. No joking. It is the beginning of April. We have a whole lot to go through here. Oh, and by the way, the Tigers got their first win last night, so that's cool to see. So stocks are lower and mortgage bonds are higher to start the day, with 10-year bonds continuing to improve, breaking beneath their 200-day moving average and looking to retest the lows from all the way back at March 4th, about almost 30 days ago. So we start the week's jobs data with the JOLTS report. And this is jobs week, everybody. So the JOLTS is the job opening and labor turnover survey, and it showed that job openings fell from 7.76 million to 7.57 million, which was lower than the market forecasted at 7.63 million. Importantly, the subcategories, the quits rate, which shows the quits rate remained 2% after being revised lower from 2.1 to 2% in the preceding report. It's still at near some of the lowest levels that we've had since 2015 when you remove COVID. This shows the weakness in the labor market, as the lower quits rate means less people are feeling confident about getting a new job. Now, we also had the ISM Manufacturing Index, and some subcategories on that were very important. So, overall, the manufacturing index was reported at 49, which was less than the expectations, slightly from what the market thought we'd see at 49 and a half. Now, that's a move lower from the previous report of 50.3. So, we're in that contraction category under 50. The employment component was very weak, dropping from 47.6 to 44.7, firmly sitting in that contraction definition. Of the 18 industries surveyed, only one had an increase in employment, with the rest remaining stagnant or declining. And that shows the subcategories of weakness within the jobs market. New orders were also very weak, dropping from 48.6 to 45.2. The one negative was prices paid. Now, this is an inflationary measure, which rose from 62.4 to 69.4. That's a big jump month over month. And this is mostly due to the impact of tariffs and the implied tariffs. The big news tomorrow that we're going to be waiting on is the ADP employment report. The market's expecting 105,000 jobs in March, but this figure really has been decreased from what the market was expecting even before. So we're very concerned about a weaker than expected report. And then later today at 3 o'clock, we get some big news with the White House talking about reciprocal tariffs, what's going to be announced, and those can have a significant impact on the markets. If they are worse than feared, we'll continue to see a flight of risk off, a flight to safety from stocks to bonds. Now that could improve the bond market. Now, when we look today at the 10-year bond, it's had a big 3-day move lower, breaking through its 200-day moving average, which is great news. Yields are now beginning to break beneath support level of 4.17, and if they can maintain this move, the next stop is at 4.12. In fact, that's going to be great news for mortgage rates, as we are now heading straight into the home buying season. Yesterday, there was some commentary by a couple of the secretaries. We had conversations with Commerce Secretary Howard Lutnik out there and Treasury Secretary Bessent. Now, Secretary Bessent indicated that he wants to use tariffs for the revenue that they're going to generate, and that it will help, in their opinion, will help the U.S. reduce the deficit and bring down rates. At least according to him, like I said. And if he's being truthful, it seems that tariffs are going to be a longer term play than potentially a shorter term play. It seems for now that the market is focusing more on the demand destruction and slowdown component of tariffs more than the potential inflationary impact, and that's why we're seeing an improvement in bonds. Treasury Secretary Bessent, now he plans to try to bring down the 10-year bond lower and ask about potential drawing down of the TGA, the Treasury General Account, because it's currently a little bit over 600 billion, and pre-COVID it was closer to 300 billion. So we're double what we used to carry on the account. Because it's currently almost 600, I'm sorry, if they draw this down, it would mean fewer treasuries that have to be issued and less supply. Now, Besson did smile at this as if he was surprised at the question about the Treasury General Account, and mentioned it and said he can't really speak to it, but one could infer from his reaction that this seems to be a possibility that would bring additional good news to bonds. He was also asked if he would issue more short-term debt instead of long-term debt, to which Bessent said very clearly that it was precisely what he was going to do. Bessent also agreed that the slower balance sheet reduction from the Fed would also help the 10-year bond. Wanted to cover what went out on Friday with personal consumption expenditure, or PCE. The spending portion rose 0.4, which was lower than the 0.5% that the market expected. Adding to the mess was a 0.1 downward revision to the February reading, which brought it from a negative 0.2% to a negative 0.3%. This is causing fears of additional slowdown in the consumer and the economy. In fact, 9.7 million individuals are behind on their student loan payments now. That's also going to have a downstream effect of affecting credit. So there are a lot of concerns there. Incomes in the report double what the market planned on, rose 0.8% versus the market estimates of 0.4. But this was a little bit tempered by a 0.2 downward revision to the previous months. But still, sector wages, which are the most important, decelerated on a year-over-year basis from 3.9% to 3.2%. I'm sorry, private sector wages saw that decrease. So we're seeing more of a push up in public or government wages. PCE showed that the headline inflation rose 0.3 and remained 2.5% year over year, in line with estimates, which was good for us on Friday. The core rate, which strips out the volatile food and energy, rose 0.4%, and year over year rising slightly from an upwardly revised 2.7% to 2.8%. The market was looking at a 2.7%. But as we look forward in the year at the replacement numbers, it's going to be tough to make headway on this inflation and PCE as we go forward. We've had a super busy weekend and start to the week, multiple new offers in. We've had a couple of offers accepted already. Give us a call. The spring market's here. Spring break actually starts tomorrow or Thursday. I'm sorry, Thursday. That's a great time for buyers to be active in the market because there's less competition. We'll be on call all the time. Give us a call. We'll help you out. 616-293-2189. The Market Update Desk, your original singular market news source for West Michigan.